We own 28% of one of the largest undeveloped sulfide projects in the world. So we have a 30-year life project. What that allows you to do is that 30-year life allows you to take advantage of those peaks and valleys of the nickel cycle. And because it's such a large-scale, low-cost project, you are profitable along that entire time. So Dumont is fully 100% owned within the JV. We are now 28%, and Waterton is 72%. RNC remains the operator and manager of the JV, so we do all the technical work for Dumont as well, and then work with Waterton in terms of looking at strategically moving the project forward, financing, and marketing. Dumont is a very large-scale, low-cost, long-life asset. It's a billion-ton reserve. It is going to produce, in the first phase, which is 7 years, about 33,000 tons of nickel annually, expanding in year 7 to 50,000 tons of nickel annually, and over the 30-year life will produce 39,000 tons of nickel annually. We are located in the Abitibi region of Quebec, in a very active mining region. We have lots of local support. We are both provincially and federally permitted, and we have an IBA with the local First Nation.
Right.
So we have all of the pieces in place to be ready for the next boom. So when we look at Dumont, the one thing I'm very excited about is if you look at the world of nickel and you look at nickel sulfide deposits, the reality is there just aren't that many or any nickel sulfide deposits that are currently permitted in a low risk jurisdiction that can produce something in the order of 30 to 50,000 tons of nickel annually for 30 years. When we completed the fees back in June, nickel was $5.50 a pound. Nickel is now hovering between $7.50 and $8 a pound. Stocks on the LME are almost at an all-time low. So we're in a very different place. So we want to make sure that we do look right now at taking advantage of this current nickel price to see if there's that appetite. But at the end of the day, we're not going to fire sale Dumont. With this rising nickel price environment, it is going to draw out stockpiles of stainless steel scrap, of ferro-nickel that has been sitting in people's backyards waiting for nickel to go above $5 or $6.
I think we know which backyard.
Yes, we do.
Right.
So that we will need to chew through that as an industry.
Right.
Before
How long?
Probably maybe Q2 next year. Into Q1, Q2. Okay. I mean, it's not a huge amount, however, there is some, and stainless is still pretty soft in terms of the demand side of things.
And that's going to affect prices?
It will. It will, absolutely.
But it will bounce back up?
Yes, we believe so.
To A level?
To A level, what it is.
There we go.
Yeah, I mean, long term, we have seen year-on-year deficits in nickel production into the industry. We're on our third year of deficits.
Yeah.
I believe next year the International Nickel Study Group is predicting another small deficit. So we are seeing these deficits. We do need new nickel to come online at some point in time. And if we did do something this cycle, I really do think that first of all, in the short term, there might be a potential to offer RNC some sort of initial consideration. RNC, if we look at RNC, we do have some debt outstanding. There's opportunities for capital spend in Australia as well, potentially. So in the short term, I think there could be, if we could monetize Dumont in some way, some short-term value. I mean, I think longer term, having or retaining some sort of upside consideration is really that's where you get exposure to the $10 to $15 nickel prices. I mean, the last time nickel ran, we went from $1.98 nickel up to $25 a pound nickel. Yep. Nickel is the most volatile of the base metals. It goes the highest and it goes the lowest, and it dives the lowest. So having some exposure to that long term, I think that's how we go about adding value.
What do you think you need to deliver for this cycle to be able to put you in a position to give you the opportunity to have those conversations?
Yes. No, absolutely. So I mean, I think right now what we're looking at is one was completing the updated feasibility study.
Right.
We had to do that just because if we had not done that, we would be trying to market Dumont with an outdated study.
Right.
So that was done,
tick.
Exactly. The next stages, I think, are one is off the back of that study. We need to make sure that our stakeholders, which include the government, include the local communities, are all updated on the study, as well as updating things like closure plans, updating, looking at our C of A's, making sure that we don't need to do anything there, or if we do, start to take care of that. Because what we want to make sure is, we build Dumont as a shovel-ready project, which essentially means, what is shovel-ready? Shovel-ready means that you have your permits in place, you have your land ownership, you have your surface options, you have your mining lease, you have your closure plans, you have your technical study up to date. So making sure all of those things are maintained, because updating your feasibility study, that feasibility study forms the basis for all of those sort of feed forward information flow to the government,
right.
As well. So the next, in the short term, making sure that we have all of that, maintaining our shovel-ready status, that is very important. So in the feasibility study, we saw some opportunities around automation, truck automation, just like the EV story, just like all of those things. Haul truck automation is coming along faster than is, so by the time Dumont gets into production, trucks of that scale will almost all be automated. So we want to look at that because that adds significant value. We want to look at potentially magnetite offtake. We want to look at some technical equipment choices. So there's a few things. We'd like to look at that over the next sort of 6 months to look at is there an opportunity to add more value to Dumont?
Right.
Because that really speaks to investors who want to come in to say, what are my upsides? I mean, if you look at the free cash flow of the project over the life of the deposit, somewhere, I think the EBITDA is $200 million annually. I mean, it's a large cash generating project. It is a low cost, overall our C1 cash costs over the life of mine are just over $3.22. Our all-in sustaining cash cost per pound on a US dollar basis is just under $4 at about $3.90.
Okay.
So, when you're looking at projects to invest in, because the thing about nickel, I talked about it before, nickel is the most volatile of the base metals. It jumps the highest and it falls the lowest. If you're going to invest $1 billion in a project, you need to make sure that $1 billion is going to be paid back. You need to make money.
And there's a cost to it.
And there's a cost to it. There's an interest there. There's a cost to that.
To everyone.
To everybody.
Yeah.
And so the reason why I believe in Dumont, one of the other, is just because of its scale. So we have a 30-year life project. What that allows you to do is that 30-year life allows you to take advantage of those peaks and valleys of the nickel cycle. And because it's such a large-scale, low-cost project, you are profitable along that entire time. So any investor that comes in has that time on their side to be able to get back their investment. Because nickel, unlike say copper, it does really go up and down. So that's where I think there's an advantage of Dumont, where when you look at some other projects that say, are 3 to 4 or 500,000 or $500 million to invest, but are only at 10 years, you can really easily miss the price cycle.